Hello everyone and welcome back. In today's video, we discuss the stock, commodity and crypto markets right now, including the key inflation figures that just came out in the last 24 hours and what they meant for this market. Markets across the world are free falling at this stage, and catching the falling knife can be dangerous. The question is, will the SP500 get through the negative 20% and enter bear market territory? There are some defended zones coming up for multiple markets around the world. Let's talk about it right now. Plenty to discuss. Well, welcome back everybody to the daily show here for the markets close the 11th of May 2022. And as you can see, when we load up the fear and greed index for today, it's another new low. It keeps latching itself down and we're in extreme fear. I'm pretty sure everybody is aware of that by now if you've been looking at these markets. We mentioned inflation, and of course we mentioned the idea that the CPI numbers are out. So as expected, certain things occurred. One of those was the 10-year dropped. As I've been saying on this channel for a little bit, we expected as of the end of last week for the 10-year to start dropping, and it has been so far. If you take a look at this CPI heat map, it's not an extremely big number in terms of we actually see a slow here to 8.3% for headline and 6.2% for core. Inflation, and basically it's more of the same, but you can see it around you. The big notable here was food increased at a fairly steady pace and fairly steep pace. Let's also talk about where inflation is and isn't. Of course, in the markets that is important. Gasoline, well, we can see that by looking at, of course, oil price and looking at the spot to tell whether that's coming down or not. Airfares have gone up substantially. Makes sense, of course, it directly reflected to gasoline. And then we think about used vehicles. Now, used vehicles dropped substantially, and I expect that to continue to drop as people feel a little bit poorer. Maybe they don't need the second vehicle, possibly a huge amount of supply of vehicles coming online as well, with people needing to sell their cars because maybe they don't need them, or maybe they also make the decision that they might want to invest that money into the markets, or who knows what they're going to be doing. They could also be getting margin called if they were in Luna, unfortunately. Let's talk about the stocks across the board. It was really the day of Apple falling. Apple fell 5.18%. This stock has been incredibly resilient, and then it fell straight through. We've got some great technical analysis to go through later on that one. Tesla down 8.26 as well. We'll talk about that. So plenty of market shenanigans and a lot of declining movements here through these markets. We see that we had a bit of a rally in the first early session of the markets. Basically, we had the core CPI number come out, the market dumped, the market recovered back to where it dumped, and then it sold off pretty much that exact same zone and fell lower for the session. We were down as much as 3% on the Nasdaq, and they all closed on their lows, showing that Wall Street wasn't really convinced to buy it at the close of the day. Remember, the close is where Wall Street's at, and where we are, the retail traders, tends to be the open. And of course, if you can reverse that concept, you might do well, or at least know about the trapping that happens at the start. Let's also talk about sectors. It was a day of mostly defensive sectors doing better. XLU, XLP, the two main ones that come up here. That's staples and utilities. We also saw energy have at least a stabilization day, but things like clean energy, my goodness, PBW down 7.78. Anything that's been valued on PS ratios, hyper stocks, anything like that has really just been getting hit day on day on day. And anything to do with crypto at the moment is getting absolutely destroyed. Load up a coin chart and you'll see what's going on. And of course, we did caution against anything to do with IPOs in America during 2020 and 2021 because they tend to do poorly after launch. Remember, if there's hype coming in and it's a technology stock, usually it isn't worth even considering for 12 to 18 months until after, and coin just shows that again. Not many higher days for 2022. This is something that is almost worrying in some ways. 43.8% of days are higher. That's not good. I mean, this is actually a very low stat. You can see here, not many times has this ever occurred. It doesn't necessarily mean recession or anything like that, but the negativity so far this year has been significant in comparison to positivity during some of these high years where you get that 59 to 60% bullish days in a row. Let's also talk about exceeding something else that's a huge stat. And we've mentioned this several times. I'll just quickly go through it for anyone that hasn't watched it yet on the channel. By the way, welcome. If you haven't already, consider subscribing. And of course, guys, smash that like button if you enjoy these videos. Let's talk about 6 weeks down. So we'll look at this later, but we basically had 5 weeks down in markets. It becomes statistically unlikely to go too much further. Remember, this is already statistically unlikely to occur. And something like this is important because if we're hitting levels of demand or support, then if we're 6 weeks down and we have an average kind of period, then it could mean a bit of a rip rally is going to start. Doesn't mean that we're necessarily out of the woodworks and everything's going to improve, but certainly a turnaround could be very close to happening. We'll talk about defended zones soon. Q1 earnings beat data still at 70%, and basically beats and misses still looking okay. So it's not really about the beats data at this stage. It's obviously about the forward projections the market's doing. And we just have to really ask ourselves the question of how bad is everything really? Is it as bad as we're being told? Or is the market about to potentially turn very soon, at least give some kind of relief rally? And we'll check that out very soon. Speaking of badness, let's have a look at fear. The fear is still very high, 32 on the VIX, not quite 35, hasn't broken through. That could mean that we haven't hit the capitulation zone yet. That is usually the sign of kind of the last final step of fear before turnarounds occur. We'll look at that soon. PCC, put call ratios, continues to be quite high. Lots of puts in the market, everyone. We'll take a look at them later. They're everywhere for next week for the 3rd week expiry. So yeah, a lot of puts being entered, a lot of fear coming through these markets, and heaps of hedging going on. Copper is another thing that people look at. This is known as Dr. Copper. Sometimes it can show you whether economic activity is heavily slowing or not. And copper has been declining, but we do have a huge support demand area through these lows. And as you notice, it's currently being supported by that. So that's a good sign, and copper holding up will be important to our discussions moving forward. Another thing is US 10-year. So we mentioned that US 10-year had probably peaked exactly here. And this was because we saw the weekly as well. Now, it doesn't mean that you're always 100% correct. Of course, this is a multi-month approach, not just looking at 1 week or anything. But if 10-year has hit the highs and we expect it now to potentially come down, that could be good for markets around the world. Remember, I've got a bit of an idea based on some lead indicators that I use that this could be occurring. And so far it's worked. And that's had, of course, a direct reflection on things like treasuries. And treasuries are currently moving up off their demand support zones over here. And look, they've come down very heavily. You got to remember, treasuries have fallen a substantial amount. If we actually took the distance here, and then you work that out again as a new kind of step. See how the legs are very similar? And then, of course, you would expect, therefore, maybe a pullback to be similar. And where does that occur? Back in. Now, when you can do technical analysis that way, which we'll even look at the stock market in a minute from that perspective, it becomes much clearer what could be possible in the future. And then you can start to dial in around those concepts. Let's look at the dollar index. So, of course, cash is king so far in 2022. You never thought you'd be saying that during inflation, yeah? But it is, and it keeps grinding higher. But this could all be a bit of a bull trap. Remember, at the moment, you can't tell that the trend is moving down or anything like that. This box represents weekly resistance on the left-hand side. And in general, it's just kind of grinding higher, but it's not like exploding out. It seems to be consolidating at this stage. You really need to break down the smaller timeframes here, and we don't have a clear change of trend or anything like that yet. So it's more just guesswork, and I wouldn't guess against the dollar until it shows you the confirmation. At this stage, we haven't seen that. Let's go over to gold. Now, this is where things get really interesting because we've broken through some downward trends. So basically, this is the downward trend, and we breached that. You can see the CPI number, and then it instantly came back up. Now, I've got a highlighted box here, which I expect to be some form of selling pressure to come back through. But I could see it doing something like this, and then potentially breaching this. And if it did, I think that gold could be looking more positive. It does tend to lead into a concept that gold could do well here. Everyone hates on it at the moment, and rightfully so. I mean, it's been going down, and I'm not going to say that the downward trend is over yet. I don't know that. But if the right things occur, we'll certainly be discussing it. And at this stage, it's back where that previous kind of resistance was, all the way back through August, all the way back through January. And gold's finding a little bit of a bounce now, possible weakness on the shorter time frames. And if we get that strength, of course, we'll talk about it soon. Another one that's starting to show weakness is natural gas. So natural gas came up to that 61.8. It sold off, breached above. At that point, you pretty much knew this high was going to get taken out, and it did. It's since crashed, okay, which is probably a good thing. I mean, we kind of need gas and oil to come down, because if they do, again, that could be good for the stock market, good for this inflation story, and it's what we're hoping is about to happen, especially with this 10-year coming down. It's kind of showing that might be occurring. So because this is such a huge blow off, we might expect it to come back to something like the 61.8 fib, and at that point there are some smaller time frame resistances that I think it could sell off. So that 61.8 to 78.6 level, I could see shorters coming back into natural gas. It's a crazy pair, but certainly around that area is of interest. Let's talk about Tesla. So Tesla fell through 760. It's coming down into this previous demand area. So we had a lot of demand through and resistance supply through here. So this is a big zone for Tesla that's coming into. All of this area has been tapped many times before. And if you look at it on the chart, it makes a lot of sense. We've got a lot of long leg dojis, rejections, buys, all sorts of things. 700 in particular is a huge zone for Tesla, and if it is hit, we would expect some buyers to try to come back in and support it, though Tesla would not be the first thing I'd be looking at in these markets. When you see so much fear, you generally want to be looking at the SP 500 as much as possible to get a bit of an idea of where we are in terms of support resistance. If we breach underneath these zones, the unfortunate news for Tesla holders is we might be going all the way down, and that will push us back into that kind of 550 to 580 zone. Not good, of course, if you're in the stock. A lot on the line in the next couple of days of trading. Apple, we mentioned it before, it's broken through the downward trend. So here we've got this upward trend. We've now broken it. We've gone underneath. Do we move now towards that 140 box that we've been talking about for some time? Resistances, supports, a lot of demand through this area here. Apple's a huge stock. If it starts to fail, and let's say we've just seen a huge distribution on this, if Apple really starts to tank through some of these zones, it really could be bedlam on the market. So at this point, we hope that, of course, this becomes the buy area for Apple, and possibly it might have just false broken down here, but in general, that you would probably expect it to try to get back into these zones and then looking for structure on the smaller timeframes, etc. Let's move over to the Nasdaq. Does that make sense with the Nasdaq story? Well, I think it does. We have here a Fibonacci between the 2020 lows and, of course, the 2022 high here, or I think it's 2021 actually. Yeah, we hit it in November. So basically, this is a 50% fib pullback. 50% has been taken off. You'll notice there's tons of congestion over here. Previous resistances really based on that August period of 2020, and we're coming back into a whole bunch of demand orders that are going to be going all the way through here. On the bottom end, we kind of have that 11,000. On the top end, we have that 12,000. So I boxed up what I think is most likely, which is somewhere around in here. And we're getting into that zone now. So smaller time frame traders will be looking at this and saying, okay, do I see the change of trend, the lightning bolt, the double bottom, the bust max pain, and then the rally through this area here, changing, of course, that smaller time frame trend and allowing me to get back in to potentially buy the dip. This is a big zone. And the further it goes, especially if it gets down here, and the further it's away from this moving average, remember, once you move away significantly, it tends to want to mean revert, that is, pull back into that zone. And right now we are, from the bottom to the top, 17% away from it. So if we think about previous times when this has occurred, obviously this was a full switch over, but this was a very big freak out of the market. So here it was about 23% away from it. But let's look at normal market conditions. Here we've got a more normalized market, and from the bottom to the top here, about 15%. So we are statistically pretty far away from this, and it does tend to want to revert back to these zones. Even over here during the epic crash that occurred, this was probably the biggest one, and this was the GFC. This was fully fledged, yeah? At that point, it was 40%. So it can get really far away. But in general, they don't like to move too far away from mean reversion. And I think that that's something that we could consider on these charts, and especially the daily one. Remember, the daily so far has held up as huge resistance. So where have we got a potential rip zone? Let's say it comes up. Would this all make sense? I think it would. 13,000, 20 moving average, 20 moving average, 20 moving average, 20 moving average, daily 20 mean reversion. Look at it. Every time, big level. huge zone in the future if we do end up seeing a bounce. And I'm sure a lot of you will hope for that. And it does seem statistically likely. Let's talk about some statistics then and say why this might occur. Well, firstly, let's take the leg of this move and take that leg again. And you'll notice, just make sure I got that correct. Yep, that's the right size. And you'll notice it's kind of where it is right now. So I've got a box slightly underneath, which is based around percentage from the top to the bottom as well, what I would consider a potential defended zone by the market. This is now down about 18.5% from the top, and down here would be about 19.56. So after 20%, we enter what's called a technical bear market. Markets don't really like going down underneath those. We've seen them a lot of the time stop just before and then bounce up. Again, are we really far away from certain things? Well, let's have a look here on the smaller time frames. Remember, this length and this length are very similar. So what could that tell us about any pullback that may occur? Well, if we do get a pullback, probably don't want to take that day. We'll take this length here because that was the last move. If we do get a pullback, where do we expect it to go? Well, if it came off this level, or let's say it comes off the level that I suspect we might even hit, well, that would put us straight back into that 4,300-ish zone, which is a massive zone. So all of these kind of confluences together help us to make decisions. Again, 20 moving average, a huge deal, was a huge deal here in general, is a huge deal again. So do we pull up? It kind of makes sense. Even if we go a little bit lower, we will eventually need to rip back to the 20. It's just the nature of how markets usually move. Let's talk about puts. So this is for the expiry the 20th, so it's a week away. Take a look at some of the puts and where they're sitting, and I think that number's probably wrong. But let's look at these put levels. And you can load up Yahoo options or go into our Discord community, the private Discord community, and grab it off the bot, and it'll show it to you in a more beautiful scale here. 380, 385 is pretty big, 390, and then of course around that 400. There are puts everywhere here going to expire next week, and they're not small numbers. Look at these sizes, 110s, 120s. Wow, they're huge. And that can change, but it is still very, very large. Let's have a look at this week. Where are the big numbers? So of course we've got that 380 huge number, we've got the 385, and we've got the 390. There's actually a lot less than you'd think around the 400 levels. So of course, why are we pressuring this 390? Well, we might push through and then bounce back up. And then this becomes, of course, our defended area. So there are a lot of things pointing towards potential here around that 19.5 to 20. Of course, picking the knife is very difficult. I'm going to give you a case in point here of why you need to be careful. And this is a cautionary tale for everybody out there, and risk management and everything like that. Luna. If you're not aware of this, it is some form of crypto. And basically, I don't know the full story. It's not really, I'm obviously very sad for people that are in this, but this is the risk that you place here when you get into these. Look at what happened, guys. Complete apocalypse. And in a few days, this thing has wiped off everything it's got. And unfortunately, that's led to, of course, significant losses from people. And, it's really sad. Like, I wouldn't even consider looking at that Reddit. It's pretty bad. So from the top to the bottom now, we've wiped off 99+% of this particular coin. It did it pretty much in 3 days. It just fell like a knife. And this is what's capable. Of course, you might say in hindsight, well, it's obvious that this would go. But there are other cryptos right now in the markets that are falling substantial amounts. And of course, Bitcoin is also feeling that pressure. It's just rolled underneath 29, which it's found a lot of buying at. And as we said, at this stage, even though this is technically a demand zone, yeah, it is demand, but crypto is not feeling that positive right now. I would look for structural base. Generally with crypto, even if it rallies, it does like coming back for another action point. So when it rallies initially, it likes to come back and let you back in. It doesn't just go, especially right now. It probably will form base and give you the ability to be disciplined and sit back. Remember, BTC shorts also rose heavily through this point here, and they finally snapped off that March 22. It's not as big as it was last time in terms of BTC shorts, but they're certainly huge. So cautionary tale there, a lot of risk coming into these markets. If you haven't already, why not consider following us over on Twitter? Of course, this is just a bit of a stat here to show we've got to be careful. When we have so many losing weekly streaks and we have all these averages here, we tend to have really rough 3 and 6 month periods, with 12 months improving, sure, but the next 3 and 6 months are going to be a trader's market. Things are going to be up, down, and all around. So follow us at FX Evolution, and just remember PPI data is coming out, everybody. If you not sure, get your economic calendars out and make sure you check that out. A lot of information coming, a lot of trading to be had, and obviously it's all about being disciplined and have patience. Thanks so much. Consider subscribing, smash that like button. We'll see you in the next one.